Welcome into Dollars with Dennis. Glad to have you once again. I'm Ben George with Dennis Hoare of Faith 401k and Money Management there in beautiful Loveland, Ohio. And Dennis got a great question today. Everybody thinks about, if I had $1,000,000, what would I do with it? Well, we're going to dig into that today a little bit.
Great. Everybody needs $1,000,000.
It's a number that everybody kind of targets. I don't know that it's quite worth what it was 20 years ago, but still, if you have that into invest, what is the best strategy? So we're going to share, I guess, 3 strategies that we pulled from a recent article from a few different financial professionals that had different opinions on how you would invest that money. We'll get your thoughts on each one of those. But then we'll also break it down on how you and your team would help somebody answer this question and how you would help them approach their investments with that $1,000,000 in cash as well. So should be a good show. If you have questions, again, as always, we'd love to hear from you. Faith 401k Money Management can be found online at 401k.faith, or you can always call directly at 513-898-1897. So for this article that we're going to share, you'll also see it in the show notes if you want to look at it for yourself. Here's the prompt that they threw out to the 3 financial professionals, Dennis, and what I guess ultimately we'll have you kind of base your response on. But the 3 advisors were asked, how would you advise a hypothetical investor who is in his or her late 40s, who owns a home, has $300,000 in a retirement account and $300,000 in other assets, and also has the $1 million cash to deploy in today's market? So pretty good situation for this person. But here's what the 3 different professionals, I'm going to give you each one, let you weigh in on them. So Stephanie Linka Hightower said diversification. She'd go 60 to 70% equities, 20 to 30% bonds or private equity, cyclical sectors, and dollar cost averaging. So seems like a pretty traditional approach there. What do you think, Dennis?
Yeah. So when you ask 3 financial advisors the same question, you're going to get three different answers every time. And I kind of like Stephanie's approach here, but there's a little bit in the what was said here is we don't know if they own their home, but we don't know if it's paid for. We don't know really what their long-term goals are and what their long-term needs are. So that we need to know a little bit more about this person. And it's why I always say everybody needs a financial plan so we can delve into that. But I like Stephanie's idea of mostly equities, dollar cost averaging. So if you believe the market is high today, stock market, and you average it in over 4 or 6 months, that will hopefully get through some of the cyclical stuff. So bonds and private equity provide some different streams of income, as we talked in the last episode of what bonds can do. And then the cyclical sectors. Sorry.
I'm saying that 5 times in a row.
I know. So I think that's a pretty good approach overall, but I would want to know more about where they are and where they're trying to get to before I gave my complete answer.
Absolutely. Goals definitely would weigh into this quite a bit. But here's another one. Here's what James Thorne of Wellington Altus said. So this one may be a little bit more aggressive. He says innovation, AI heavy, NASDAQ and S&P, China ETF, 10% gold or Bitcoin, gold and Bitcoin, energy and financials. So seems be a little bit riskier on this one. What do you think?
Yeah, I think James has been talking to my son. That's exactly the portfolio he would live in. Only he would have a Pokemon in there as well. So it is a bit aggressive, but if you look at the situation on the surface, they already have a $300,000 home. They have $300,000 in a retirement asset. So it might be that they want to be a little bit more risky. Can't read that into the question, but that certainly would be an aggressive portfolio. And there are some people that want or can tolerate that kind of a portfolio because it will be volatile. Everybody's talking about innovation and AI and what's doing. It's changing our landscape in the financial world. Maybe the price to earnings ratios are elevated due to the escalation there. So James he's on the right idea, but he's got to have the right client for that portfolio. I'd like to see the results in 10 years.
Yeah, no question about it. All right, one last one here from Dennis, who says 70 to 75% equities, conservative bonds, tech and AI, industrials, healthcare, financials, and staples. So that last one, Dennis, what do you think?
Yeah, so a little bit more like Stephanie's in the beginning, a little bit more traditional, if you will. Doesn't say what type of equities, but James was more aggressive. Those are all equities there. So, but I think she's different. Dennis is on the right track here to getting them to where they want to be. conservative bonds, treasuries, tech and AI, industrials. There's some very solid categories here of the market. So that could be all three of these are the right answer for the right client, and all three of them are absolutely a disaster for the wrong client. So knowing your client, knowing what we're trying to get to is probably the main objective. I think everybody needs to have a plan that says regardless of what money we have, where do we need it, what do we need it for, and how much does it need to be at that point. And that's where the written financial plan comes in, is so important to our business and how we help clients get there.
And I think you make a great point, right? These could be outstanding portfolios for you, but they could also, the same portfolio that works well for you might be awful for somebody else, and vice versa. So you have to have a plan that matches up with your goals, with your needs. And again, that's what a customized plan does. So let's dig in this a little bit more, Dennis, from your perspective, and just how you go about the planning process and help someone determine their investments. And I want to start with age, because obviously it's going to be different for you depending on what age you are, how aggressive you want to be, and how your strategy changes. So kind of explain to us how, maybe age 40 to up into your 70s, how that strategy typically shifts as you get older.
Good question. So the assumption would be that at 40, you're going to be in the market for quite a while, 20, 30, 40 years. So you can probably take more risk and be more aggressive in the growth. So you're going to have more equities and alternatives, because you're looking at a long runway in your 40s to go there. As you move into the 50s, you're going to transfer your risk. You're a little bit more risk aware because you've been through some ups and downs and so forth. And so you might look at some fixed income and some buffering the downside where you can for that kind of stuff. As you go to the 60s, you're transitioning to retirement, and that's when most people start to do their planning. I think they need to start their planning in their 40s to get the best result. But if they're going to start it in their 60s, then it's going to be more income focused. What do we need to live on over the next 20 or 30 years? And I always go back to, geez, people want to retire earlier, and we're all living so long. So how do you save enough money in 30, 35 years to last 35 years? That's the real challenge. And finally, in the 70s, preservation, tax management, healthcare costs, estate planning. So these things shift as we go along, but that is why having the plan in place and being able to adjust to the needs as people get older is pretty important, and not everyone is the same in any situation.
Yep, absolutely. And I'm curious, kind of, beyond the portfolio, I know, the idea here is how would you invest, but what are some other things that you have to be thinking about as you're building a portfolio and as you're trying to build a plan for retirement, and how you're going to use that money that you're earning in that portfolio, hopefully? What are some other factors that that aren't touched on in this article that you would suggest somebody think about when they're doing this?
Yeah, so tax planning for one, because taxes are a huge part of our world, and you can't get around them. It's the only way you don't pay taxes don't exist. You live, you pay taxes, you earn money, you pay taxes, you save money, you pay taxes, you die, you pay taxes. So tax planning is important. Roth conversions, capital gains, and the timing on those are really important to people's portfolios, and getting into the sequence of risk and risk returns. And looking at their liquidity needs. So do they have enough liquidity to last through a downturn or a bad health issue, something there along those lines? And then the behavior and emotions, comfort with market volatility, which is different for every single person. When I ask somebody if they can take a 20% correction in the market, almost always get yes for an answer. But when I say, okay, when your $1 million goes to $800 and you're down 200,000, how's that? That it's a different answer. It's a different reaction. So getting the right questions and ask the right way to judge the risk tolerance and how people react to volatile markets is a tough job and also important.
Yeah, knowing how you feel about the market would be specifically important for that answer from James on the very risky portfolio, the aggressive portfolio that you threw out there. You might not be too comfortable with that if you feel strongly about the ups and downs. But it's interesting to hear how you build that portfolio, Dennis, and some of the things you need to think about. I know, I think what's most important is to realize that every plan is going to be unique, right? What sounds great to one advisor and one professional might sound completely different from person to person. So you want to make sure you have the plan in place that meets your needs, that you're able to sleep at night, feel comfortable with your allocations moving forward. And again, it all depends on who you are. So reach out, Faith 401k and Money Management. You can find them online, 401k.faith. All the contact information is in the show notes below. So please don't hesitate to reach out, contact Dennis, begin talking about your strategies. Even if you don't have $1 million to deploy right now, no matter what it is, you want to make sure you're doing it the right way. And that's what they can help you with, as always. So Dennis, any final thoughts before we get out of here?
Just everybody has their own plan. They got to be able to sleep at night. I agree. And so getting that written plan in place so you know what to do when things don't go the way you thought they would. You can always come back and say, okay, let's readjust from here. So it's really important to start with the planning part.
Very good. Well, thanks for following us here on Dollars with Dennis. If you enjoyed the show, please subscribe wherever you're listening or watching. We'll be back again soon in another episode. Stay tuned.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.